first and foremost, the idea that transaction costs have come down for all investors because of the liquidity rebates, that has not been the experience of the Capital Group. In fact, I've produced a graph here that shows from 2008 to 2015, really when Reg NMS went into effect and has been in effect since then. The graph here shows our normalized transaction costs for U.S. equity securities. This is data that we get from a third-party provider, ITG, who analyzes our data for us. And you can see that the evolution of those costs and the normalization is to the average cost over this period. But in the early part of the 2000-2008, during the financial crisis, we saw a spike in our transaction costs. And then afterwards, and from 2010 on, really we've seen a pretty steady state, quite frankly, of the transaction costs that our investors have when we implement portfolio decisions for them. And it's not surprising to us because as we've looked at our transaction costs over time, I should say that the period that I use from 2008 on is more of a trying to have a consistent time series data. Prior to that, some of the order definitions were a little bit different in our group as we've increased our ability to look at transaction costs. But if you look at the period from 2003 to 2004, you don't see much different than the period from 2010 to 2011, quite frankly. And as you look at, and I just supplied a proxy for market volatility, which we think is the main driver of the transaction costs as we enter the marketplace for our investors. You see that our costs actually mimic what happened in volatility generally. They were pretty low and an all-time low prior to the Reg NMS going into effect. We had the spike from the financial crisis go up, and then afterwards we've seen volatility drop to levels seen before, and again, low levels. And in fact, when you hear, I hear constantly that transaction costs for all investors have come down over the last 20 years. It sort of also follows the pattern of the VIX if you look at over a longer period of times where you can draw a line, and I have done that on a regression basis, where you do see slight drop in transaction costs over time. I would conjecture that that's due to volatility and not any sort of market structure or rebates being passed on to liquidity providers to incent them to display.